What's up, guys? Welcome to Roensch Capital Charts. Today we're taking a look at Nvidia stock, ticker symbol NVDA, on a variety of time frames in anticipation of the next trading day, Tuesday, May 21st. All right, guys, Nvidia stock here today up $23.01 per share. That's plus 2.49% in regular trading hours. Let's take a look and pull out everything we can, getting the best feel for Nvidia as we possibly can heading into tomorrow, Tuesday. Of course, we have earnings coming up on Wednesday, so it's coming down to the wire here. And let's take a look. We're going to pull out some directional bias if we can out of the volume profile. We'll look at the psychological levels the traders, the institutions are watching, so we need to be aware of them. The implied volatility, particularly important if you're trading options. The expected move for tomorrow, and the directional bias coming out of the chain for tomorrow. So listen, let's get started here with the volume profile analysis, pulling out some directional bias if it's available here on the 5-minute chart. By the way, guys, Nvidia earnings coming up. I am covering Nvidia every single day. It's not just because of earnings, by the way. It's just a staple here on the channel. So if you can appreciate that, please subscribe to the channel. Helps out tremendously, and I'll keep the Nvidia videos coming. So let's take a peek under the hood here. The price action already happened. We know what happened. It's up 2.5% on the day. But what we're really looking for here is, okay, is there any bias that supports or maybe doesn't support that movement? Now, bulls, ideally, in a perfect world, on a 2.5% green day, we would see at least some bullish bias in the chain. I'm sorry, not in the chain, in the volume profile, right? As well as, I suppose, the chain, which we'll get to at the end of the video. Because that would show here in the volume profile that that supports the move that already occurred, that we already saw once we look under the hood. Whereas if you're bearish currently, well, you can't really expect to see a bunch of bearish bias on a 2.5% green day. So what's your realistic good scenario? Well, ideally, you really wouldn't want to see any bias at all, none, because then you don't really have any bias in the volume profile supporting the move that we already saw occur. Okay, so let's look here. Now, we get a high volume open. That's pretty contextual. If you compare that to Friday, it was a little higher, but it wasn't, I mean, we're talking a couple 100,000, maybe 300,000 more shares off the open than Friday. So it's a little higher, but it's not triple, right? And then volume fades off very quickly, which is what we expect. Now, granted, we see a fade to a higher volume green bar and then a fade. That's very normal. A fade, very normal still. You tend to see this kind of clean fade off the open, and you get that one green bar that pops. Now, listen, guys, if we were assigning bias to every single bar that pops as a lone outlier, we'd be here all day and we would never get anything done. So the problem is I can't, if there were 4 bars in a row that were higher out of context volume, and then it fades back to red immediately with lower volume, that would be obvious bullish bias, but it's one bar. I'm uncomfortable assigning anything to that. So we see this fade off the open. There's really nothing until this very small amount of bullish bias, kind of like around midday-ish. Okay, it's small. We're talking like 5%. Then we move forward. You start to see this little pop, probably even less than 5% because we're seeing it ascend. It kind of is just a lone outlier. And then into the close, very contextual. This bar here, by the way, whether that's green or red, I tend to ignore that one. That's a rebalancing bar. Okay, the algorithm triggers upon the closing bell, pumps up volume, a lot of buys and sells, typically leads to very little actual movement in the stock. So I tend to ignore that. So listen, guys, from a bullish perspective, looking at here at the volume profile, I'm not like thrilled about it, okay? But it's just one factor of many, but we have to dive deep into each factor to truly get the best understanding we possibly can. I'm not super excited about that. There's very little bias. It's very little bullish bias. And bears, you know, it's not no bias at all. There's a little bullish bias, but you know, it's not the worst thing that could have happened today with tremendous bullish bias for you guys to support that move that already occurred. But as I always say, at the end of the day, it's a 2.5% green days. So bulls still won the day, right? Just not quite as perfect as it could have been, at least as far as the volume profile is concerned. Now, let's move on to something I would argue is much simpler, but also very, very important and effective. The psychological self-fulfilling prophecy levels on the most important, the most common time frames with the most heavily watched indicators we could possibly slap on a chart. The 50 period and the 200 period. The 50 is white, the 200 period is gray. On the 30-minute, 4-hour, and daily, all we're interested in here is the psychology around the heavily watched levels. That's self-fulfilling prophecy mentality, right? That's my belief surrounding TA. Now, bulls. This is where things start to get kind of nice, right? So you guys remember the weekend video? We were talking about how, we were fading off the 50 period. Not perfect, not great, but we held the 200 period heading into the weekend. That's fine. So we were talking about best case scenario for bulls. Come here now today, Monday, would be a rip up through the 50 period, and then ideally an intraday session. If it rips up in the pre-market, then you get an intraday session test, or if it were to rip intraday, you still get an intraday session test. We got that test immediately off the open. I like to see the test occur intraday on high volume because I want a big sample size of opinion. Well, we got that big opinion, and the opinion was higher. Okay, so we held that 50 period hard as support off the open on big volume. That's just about as much as you could ask for here on a single day out of Nvidia on the 30-minute. So look, heading into tomorrow, a few things I'm looking for. Bullish perspective here. I like that the 200 period is ascending. I want to see the 50 period continue to curl and ascend even more aggressively if possible. And any downside test of the 50 period moving average on the 30-minute chart out of this stock, I don't care what volume it tests the level on, as long as we bounce away on higher volume. Okay, that shows a big sample size pouring, or a big sample size of opinions pouring back in on the bounce, saying, hey, yeah, we agree that this thing's going to bounce. And the reason why I prefer lower volume on the test, at least compared to the bounce, is that because on the test, I want a smaller sample size of traders, institutions, algorithms betting on the break back downside. It shows a lack of confidence. I mean, volume is very clear. It's very real. It is like the indicator of all indicators. It's just volume. It's so clear most people don't think of it as an indicator because it's just data, right? But that's like the perfect indicator for me because all I want is data and psychology. That's all we need in the short term at least, right? Of course, in mid and long term, fundamentals take over 100%, but the short term is all psychology, and that's where the people who are reading the real-time data and the psychology shine. So bulls, that hold of the 50 period as support would be wonderful. Bears, what's really the goal? Well, the goal is to get beneath both of these moving averages, but more realistic one-day goal, okay, at least to start, get down beneath the 50, ideally ripping through with big volume so there's no issues. And then a retest on much lower volume, small sample size of opinion, right? Betting on that rebreak. And then as soon as we test, or upon the test, and then we're holding off for a little while, boom, the volume pours back in, you reject. That could set you bears up for a near-term downside test of the 200 period moving average. All right, let's move on to the 4-hour now. Take a look here at the 4-hour. You can see that the stock is currently, we're about 3.4% away from that 50 period here on the 4-hour chart. So listen, I'm the 4-hour is always in the back of my head, but I'm really only paying attention, at least actively, if it's coming back into play, or if it's immediately in play, meaning it's right around a level specific to the 4-hour, and the two levels I'm watching on the 4-hour are the most common, the 50 period and the 200 period. So if the stock were to dump off tomorrow for whatever reason, and this comes back into play, obviously I'm watching that 50 period, the white line, currently at about 917.60. It's a moving average, so it'll move likely by tomorrow. Then I'm watching that as a high level of interest. But if that's not the case, then what I'm really looking at here, just from a bullish perspective, is that I want to see the 50 period just ascending at as aggressive of a rate as possible. Okay, I want it moving upside as quickly as possible because the more $5 and $10 increments, psychological whole dollar increments that the thing claims, I mean, it's a psychological backstop in a way, at least potentially, right? So the higher that is and the closer it is to a higher stock price, the better if you're a bull, vice versa if you're a bear, of course. But right now we're in more of like a relevant, like bullish conversation position, at least here on the 4-hour. So that's what I'm watching on the 4-hour. But the most simple chart to read, the simplest story and the most important, the daily. The daily is crucial. The daily is crucial because everybody on the planet who's looking at Nvidia, I don't care if you're on Robinhood and a retail investor who's just, playing with some smaller money because they're just getting started, or if you're a massive institution, everybody takes a peek at the daily chart, at least, right? And that's important because that's a lot of eyeballs, and eyeballs in the market means money, means decisions being made around the most clear levels. So there's no need to overcomplicate the daily. In fact, we want to look at the daily with green eyes, meaning like newbie eyes, as much so as possible, and say, okay, if you asked 1,000 people on the street, what's the story here on Nvidia's daily chart, and assuming they had at least sort of a knowledge of a candlestick chart, you want to go with watching the levels that the majority, like the biggest sample size of people return and say, well, I'm looking at this. So here's the story in my eyes on the daily chart on Nvidia. We've talked a lot about from 900 to all-time highs, really $1,000 a share. The only level is 950. Okay, that has proved to be a bit of a level, a bit of a hang-up here in the last 4 days. From there, the only real hang-up to $1,000 a share is the all-time high. Okay, right around 974, I believe. 974. So, bulls. $1,000 a share is undeniably probably one of, if not the most important levels ever in Nvidia's history, because it's so blatantly obvious. So how do we put ourselves in position to have very little hang up from where we currently stand to $1,000 a share? Well, getting above 950 is the obvious answer, because we're struggling with that the last 4 days. So bulls, primary concern, get above 950, ideally early in the day. The reason I say that is because the longer it's above a level or below a level, the more, I would say, decisive that is, because you let more and more volume pour in. And every time more volume pours in, it's another opinion agreeing, at least on average, right? Agreeing with what's going on. And if it's above 950, you break that in the first hour of the day and you hang out above there all day, well, the market's deciding that, okay, this thing belongs above 950, at least right now. Get above 950, hold 950 as support. I don't care if we backtest it 100 times in a single day. Hold 950 as support. And from there, the only hang up to $1,000 a share is kind of like that all-time high, which 1,000 is, I would say, many more times as obvious and clear of a level than even the all-time high, because 1,000 is that blatantly obvious. Now, bears, you have to think, what's kind of like your goal here? Well, I would argue the goal, if you're a bear, is to head down below that 50-day moving average. So how do we look at that from a one-day perspective? Bears, goal tomorrow, reject 950. And what would be great is if we could head down, just kind of a rough estimation here, we're looking at about a 5% downside move to $900 a share. Okay, but rejecting 950 is a great start, because the goal is to get below 9, which sets you up for a downside test of the 50-day, because the ultimate goal in the near to midterm is to get down below the 50-day moving average to really try to delay these all-time high $1,000 a share tests. Okay, that could buy you bears some time, but it all starts here with rejecting 950 and then getting as close to 900 as possible. All right, now, implied volatility. As we head into earnings, which of course is Wednesday after market close, understand that IV tends to rise into earnings, and also understand that, guys, the vast majority of the time, not always, but the vast majority of the time, IV tends to plummet after earnings. Why? Well, because IV is priced by the traders. Okay, it's literally priced into each expiration and then brought out to this chart as kind of like the entirety implied volatility coming from the whole chain. So it's literally the expected volatility being priced in to each expiration based on like the calls and puts. Okay, so when you get a higher IV, that means that the traders are expecting more volatility. That makes sense as we're heading into an earnings event, right? Now, what happens after earnings? Well, the news is out. Any catalyst, right? Once like fundamental and psychological repricing is done, which happens very quickly after earnings, all of a sudden that catalyst is gone. Now the option traders have much less reason to price in a lot of volatility, so IV tends to plummet. That's IV crush. Okay, so to be very clear, when you're buying calls and puts heading into an earnings event, you are willingly paying up a higher Vega value up front in those contracts. Vega is priced into options through implied volatility. That's the Greek, Vega. Okay, think of it as the IV Greek. That affects the pricing of those contracts. So if IV tanks, you get IV crushed, you might think, well, why would I ever buy options heading into earnings? Listen, there's a time and place. If you have such a directional bias that you think, okay, I have a very strong directional bias, I think the volatility is also going to be higher than the market is currently pricing in. Well, and you also say, well, and I also think that I can outrun theta decay at the expiration or the contracts that I'm buying. Well, there you go. Now you have a position, right? It's your opinion. There's nothing inherently wrong with buying options heading into an earnings. It's just that you have to outrun a lot. But if that's where your opinions fall, okay, that's your position. Then don't let anyone tell you it's dumb, because that's your opinion. And that would literally be an effective way to position yourself based on your opinion being you're going to outrun all these things. But if you have a directional bias, but you're thinking, well, yeah, let's say you're very bullish, but I think volatility is going to be quite a bit less than the market's pricing in. Well, then buying calls probably isn't the best way to position yourself bullish with wanting to be short the volatility, so to speak. You want to be long the stock, but short volatility. So what would you do in that scenario? Well, in that case, you could look at doing something like selling puts, okay, or opening a spread that's long the stock, long the underlying, long delta, and short Vega. Okay, now implied volatility compared to the last week is kind of flat, a little low. Compared to the last month, it's actually pretty flat. Okay, compared to the last 3 months, I would say it's in the mid to somewhat higher region. And that's really important. The reason I'm giving 3 time frames now, and I'm going to start doing this in all the videos, is because IV is so contextual. You have to compare it, obviously, to itself. You can't compare Nvidia's IV to Tesla's IV. You have to always compare it to itself, and you have to compare it to the intended trade time frame. If you're looking to buy contracts and hold them for 2 months, then you want to look, okay, where's IV in relation to the last 2 to 3 months? Where IV is in relation to yesterday is irrelevant, and where IV is in relation to the last 3 years is also sort of irrelevant, because you're looking at the next 2 to 3 months. Okay, so you can get lost in context if you're looking at the wrong time frame. So I'm going to start giving a few different time frames just to make it more clear what I'm looking at. Okay, now expected move. Again, you guys remember the weekend video. Expected move is kind of sloppy right now, because we only have weekly expirations on Nvidia, at least for now. In the next decade or so, I'm hoping we get dailies. But for now, we're stuck with weeklies, and that doesn't give us a lot of information. So we have to do educated guesswork. That's just what it is. So you look here, the expected move by Friday's close is plus or minus $82.05 per share. Okay, but we can't do the typical divide by the amount of trading days left, add back 50%, because that's pricing in Wednesday leading into earnings and Thursday, the first trading day after earnings. So it's lopsided. I would say that the current expectation is that from Wednesday's close through Thursday, so whatever gets priced in technically on Thursday, of course, after hours Wednesday, but that kind of gets priced in the next day, right? Because it's close to close in terms of percent up or down. So Thursday is likely to be priced in as the most volatile day of the week, right? Because that's where the earnings get priced in. Wednesday, I would say, is number 2. Heading into earnings is probably expected to be the second most volatile day of the week. Tuesday and Friday are kind of up in the air, because you're dealing with, second day before earnings and second day after earnings, it's kind of up in the air. It's tough to say, but it's pretty safe to say that tomorrow is in the bottom 50% of expected volatility for the rest of the week out of the 4 trading days that are left. So if we were to do our typical, like, okay, 82.05 cents divided by Tuesday, Wednesday, Thursday, Friday, so 4 trading days, add back 50%. That gives us a plus or minus expected move by tomorrow of $30.77 per share. That doesn't make sense because that's pricing in Wednesday and Thursday, right? So I would say that tomorrow, being that it's Tuesday instead of Monday, I'm going to bump up my range a little bit because that makes sense as we're getting closer to earnings. And it's educated guesswork, guys. This is so tough, but I'm going to say my range of what the market is expecting in terms of volatility is probably somewhere between plus or minus $10 and $25. Okay, and it's a wide range, but we can only do what we can do. This is going to get a lot more clear as we head into the end of this week, because that wild card of earnings, it just, pun intended, throws a wrench into the mix. And it makes it really tough to do our educated guesswork and our math. But to me, it seems like the market is pricing in somewhere between $10 and $25 plus or minus of volatility, like kind of a 1 standard deviation range of expected volatility here for tomorrow's close. It's a good start, okay? But if we start getting too specific and saying, oh, the market's pricing in $18, it's like, okay, well, where do we pull that from, right? Because we don't have daily expirations. So I think we have to leave it more open-ended here today, heading into tomorrow, deal with that range. And I think that's the most effective way to look at this. And we can get much more specific later this week and especially next week once earnings are released. And we'll even get a little bit more specific here. I think we'll be able to tomorrow as we head into earnings. So that's kind of like the expected volatility that the market's pricing in heading into tomorrow and or the rest of the week. But you might be thinking, okay, well, directional bias. It's a decent start. It's kind of a wide range, but directional bias, well, we can do that. And we have actual data, the volume, right? It's so simple, but very few people actually do this, guys. I think I've been tracking the volume in the options chains on Nvidia, on all the stocks that I cover here for years. And let me tell you, very few people will actually do this every day. And it doesn't take very long. So I've been doing this for years, and I think it's more than worth doing. This is just another advantage we can stack. And the more advantages you stack, I mean, how can we say that that's a bad thing? So we look here. We have about 630 total contracts traded here. I'm sorry, 630,000 total contracts traded here today. 377,000 of those are calls. 252,000 of those are puts. Okay, so a bit of a call side bullish bias around the overall ratio. And if we break that down by time frame, guys, interestingly, it gets a little less decisive. The 0 to 20 delta range, the short-term speculators, 135,000 calls and 132,000 puts. It's barely a call side bias, but that's basically 50-50. Okay, so you might be thinking, well, why is the overall bullish if the short term is 50-50? Because if you look here, you start going at the money contracts and then the in the money, those all lean relatively bullish, right? Pretty call heavy from the 41 delta all the way to 100 delta. Those ratios, the more at the money and then in the money and then deeper in the money, those are leaning more heavily to the bullish side. So those are going to be the more mid and longer term outlooks on average, because as you go closer to at the money and then deeper in the money, the average expirations tend to get longer and longer. Listen, guys, I hope to see you come trade every day with our private community. That's at that link in the pinned comment. Every day I'm sending out my personal scalp setup alerts, my in-play stock alerts. Those actually make up the majority of my trading volume, especially as of late. Human verified unusual options activity. I human verify all of them to ensure that there's nothing obvious going on that like a bot or something else wouldn't catch. I human verify them as unusual and alert them. And then of course my platinum one-on-one members I'm working with every single day. Hey, if you appreciate the daily Nvidia coverage, please, the best thing you can do for the channel is leave a like on the video and then get out of here and enjoy your day. I appreciate it, and I'll see you in the next one.